Welcome everyone to another episode of the Represented series. This is our education edition, and I'm extremely excited to bring on our guest and presenter for the afternoon, who is Angie Ribuffo. Please come on stage, Angie. How are you today?
I'm good, Dana. How are you?
I'm doing well. I know we were, complaining about the heat index. More so, I guess, where I am versus where you are, but it's still pretty hot, I think, across the nation. So, we're all just hanging in there.
That's exactly right. It's a little bit chilly up here, I think. I'm up here in Alaska. So, when we have a heat wave, that means it's 70. So we would be dying at 100.
We are all jealous of you in the 70-degree heat wave. Definitely jealous of that. Before we get started, please tell everyone a little bit about yourself and how you got into the industry.
Sure. So I started in the industry really as a client, and I loved the fact that it was a way to be financially successful. My husband and I be financially successful. And so when my husband retired, it was a great time for me to move into the industry from an advising capacity. I was really doing personal budget and finance for most of my career after coming out of the Air Force and after being a nurse. And so back in 2008 is when I decided to get into financial advising. And so I've been in the financial advising side of the house since 2008, but I've been in the financial services industry for several decades now. Let me just put it that way.
Awesome. Well, now I really can't wait for our fireside chat because we'll definitely have to dig into the transition from the military and then into financial services. So I'm sure there's a wealth to learn about you, but I know you're here today to talk about a plethora of things and with our focus today on great divorce. So I'm going to leave you to it. And again, thank you all for tuning in.
Great. Thank you, Dana, for the opportunity. So hi, everybody. So today we're going to talk about gray divorce. But before we do that, I really want to talk a little bit about what we're going to cover. And you can see on the slide that gray divorce is somewhere in the middle of the slide. And that's only because in order to talk about gray divorce, we kind of have to go through some of the terminology, money issues, splitting of assets, and then talk about gray divorce from the standpoint of, where we are today. So let me get started. So here are some terms that you may have heard about or may not, but in the course of having divorce, there's a lot of pieces and parts and a lot of discussion. I think the biggest thing is that most people don't understand the terms. Qualified domestic relations order a lot of times is known as a quadro. A qualifying court order is a QCO. We know about alimony for many of us, but now the term is really spousal support or spousal maintenance. So depending on where you are, you could hear alimony, spousal support, or spousal maintenance. And that really becomes important when we get to the discussion about gray divorce. Child support is child support. Community property, you know that assets from a community property state is going to be split 50-50. And there are 9 community property states. So Arizona, California, Idaho, Louisiana, Nevada, New Mexico, and Texas. And interestingly enough, as I told you, I'm up here in Alaska. So Alaska is a state where you can choose to be community property. So it is not assumed like the other states that you have community property, but you as a couple can choose to have your assets looked at from a community property perspective. That has some positives and negatives, right? Everything is then split 50-50. That may not necessarily be equitable. So most of the clients here in Alaska choose to look at it from an equitable position rather than an equal position. And the difference between the two is the fact that then they look at all assets and try to, at the bottom line, make sure that the division of assets come out equitably, not necessarily 50-50. So you don't necessarily have to split all of the income assets like your investments 50-50. It could be that maybe you get your 401k and your ex spouse could get the brokerage account, because your 401k and the brokerage account would be equally the same, but not 50-50, not splitting 50-50. So talking about equitable distribution. And then mediation. Mediation is an option for any divorce. So sometimes you start out in mediation where you are talking about primarily the assets, or you're talking about child custody issues can start out in mediation. And if you can get through mediation and come to an agreement, then the process moves right into the court system. Or if you're in a collaborative divorce process, then that goes signed off by a judge in family court, and you're done. Money issues. So 45% of marriages end in divorce because of money issues. As a financial advisor, I see that quite often when clients come in and they are absolutely on the opposite ends when it comes to how to manage finances. So part of my job sometimes is trying to help them come to the middle. You know, you may have a saver and you may have a spender, and the spender doesn't understand what the problem is, and the saver doesn't understand why the spender can't understand why they need to save. And so, you know, part of our job as financial advisors sometimes is to try and come to the middle and have an understanding of what the goal is, and it just getting to the goal. It's not really about, you know, who's spending and who's saving. It's about what are you trying to accomplish at the end of the day. So here, you know, I have a list of questions that you can ask. You know, what assets do you own? You know, what do you owe, for instance? And there's a sheet later on here that kind of shows you how you can look at that, right? Cash flow, we do a cash flow analysis. In other words, what do you have income coming in and what are your debts and living expenses going out? And I say debt and living expenses because we sometimes don't view our living expenses as a debt, but it is. When you leave this, you know, the marriage, right, you don't suddenly not have any living expenses. As a matter of fact, your living expenses probably go up somewhat because now you are solely responsible for the expenses that you were splitting or collaboratively between you and your spouse at some point, you know, coming together to cover. And now you're not doing that anymore. This is an example of a divorce worksheet here. You know, so you can see that we look at savings and checking and the CD accounts and your stocks and your bonds and your 401k, IRAs, your pension if you have one. We look at them from who owns it, you know, and is it marital property, right? So if you own your 401k, for instance, it's not marital property, you own it. But the home, for instance, you know, could be marital property, or your savings account and checking account, because it's a joint savings, a joint checking, that becomes marital. That's considered marital property. So having a list like this becomes important. And it's a really good list to just have, even for insurance purposes, when you're looking at how you can, you know, cover your property, to have how did you get it? Where is it? You know, things like that. It's a great way to do that from an insurance standpoint, and it's a wonderful way to do that from an estate planning perspective. So when you talk about estate planning, to have your assets all listed out. One of the most difficult things here for clients is the difference between what is equal and what is equitable. So again, pensions are, you know, there aren't very many companies anymore that have pensions. Most of the companies are looking at defined contribution plans. So a 401k, a thrift savings plan, a 403b, all of those are defined contribution plans if you're involved in a company that has that. It also can be looked at as if you're self-employed, then you may have a SEP or you may have a simple. that was started by you as your self-employed business owner. So that is also included here. Here, just how to assist your the attorney or the mediator. So sometimes you as the client may have to be the detective. If you're not the detective, then the important thing is to get someone that's a detective. You can do that by looking up, by Googling a certified divorce financial analyst. You, in your local area, a list of names will come up that of individuals who have been certified as a CDFA, again, certified divorce financial analyst, and they can help you navigate through this process. I am a certified divorce financial analyst, so sometimes clients will come to me to help them understand. I was just on a call just last week where the couple had several questions. They were trying to go through the divorce process together rather than bringing in an attorney. And so they wanted to know how to look and value certain assets. And they came to me as a CDFA in order to do that, because a CDFA then becomes the neutral party. Okay. So here's a list of examples of assets that should be considered: money, home, debt repayment. That's not just your credit cards, but it could be student loans that are included in there as well. Deferred compensation. We talked again about, not only 401ks, but what happens if you're in a company that you work in a company where you have options to purchase stock, right? That is also should be considered in the splitting of assets. So if depending on, who is, beginning the divorce process, again, you want to look at everything that you have and everything that your spouse has. So some things are going to be very obvious 401ks. Some things may not be quite so obvious, like options to purchase stock, and they have a value. So you want to take a look at all of those things. Again, the business, if you're a business owner, your business has value. So how is that going to play out when it comes to the divorce? Many in gray divorce situations come from a business owner perspective. And so, as the ex-spouse or the spouse that is leaving, then and who is not the business owner, there may be some compensation that has to come out from the business, because depending on how long you've been married, you probably have contributed to the success of the business. Taxes from the standpoint of carryover. So if you were carrying over a loss in taxes, right? So you had an investment, the investment had a loss, and that could be real property, that could be investments, it could be business. So any of those tax loss carryovers that you are claiming on your taxes as a couple, right, have to be viewed during the divorce process, so that each person has a piece of that tax loss available to them. Otherwise, again, when you move out of a married filing joint, you're moving into that space of being single. And from a tax perspective, that is an incredibly tight tax bracket, because you don't have a lot going for you, typically from a single perspective. So all of your income is included, as far as and your investments are included. And so you now are probably in one of the highest tax brackets as a single person who is now filing versus a married filing joint, which gets the most benefits from a tax perspective. Again, splitting of assets, credit cards, patents, copyrights. These are things that we don't typically think about when we're talking about a divorce, because it's not top of mind. It's not right in front of you all the time. But all of these things, whether it's collectibles or artwork, household goods, insurance policies, if you helped someone get a degree, for instance, become a doctor, become a nurse, become a lawyer, become all of those things that you contributed to. And it could be not just financially, but it could be just from support. So if you were managing the household, managing the children, doing all of that so that your spouse could get that degree or get that certification, there is value to that. So again, thinking about all of the things that went into the marriage, to include things that aren't necessarily top of mind, become important when you're talking about assets and how to split them. So how do you do that? How do you think about all of this? Well, one is going back and having a list. Remember the list that I showed you previously, but also here, I think, here are some places that you can look to make sure that you've got, a handle on some of the assets. So look at your homeowner's insurance policies. What does that say? What are the riders that are on there? Because that typically lists, right? A lot of the things that you don't think about from day to day. A lot of them have riders, like personal article floaters, for instance, that cover jewelry or cameras or, expensive items that you have are included in your homeowner's insurance policy. So you may want to take a look at that just to remind yourself of what you put on there as coverage for your homeowners on your homeowner's policy in case something happened to your home. All of those things have value. County property tax records are another way to look for real estate assets. So if you think that there are other real estate assets out there that you are unaware of, a good way to do that is to run a county property tax search to see what's out there. Also look at your previous tax returns. Look at wills and trust documents, right? What did you list on those wills and trust documents to say, hey, this is something that we want to make sure is divided should something happen to us. Well, something is happening to you. You're going through a divorce. You're going to have to redo the will and you're going to have to redo the trust documents. But those documents also list assets that were incredibly important to you. So take a look at them. Business tax documents and returns, again, similar to your personal tax returns. What do those business tax documents say about the value of the business and what the business is actually bringing in? An area that really doesn't get a lot of highlight is insurance issues and concerns. So insurance is an important strategy in any financial plan, especially during a marriage. We talk about it all the time. What happens if one of you, predeceases, the other passes away early? What happens to the remaining spouse, right? Well, it also should be considered during divorce. So why? Because if you have an insurance policy, right, typically the beneficiary is your spouse, soon to be ex-spouse. How does that work? You want to make sure that if nothing else, the beneficiaries are updated, right? In many cases, one of the things that happens is we forget about insurance. We don't update the beneficiaries. The ex-spouse passes away, and the dollars go to the previous spouse because that was never updated. That's really detrimental to a family, especially if one or both of you have remarried, right? And you find out that the current spouse is now not the beneficiary of those assets. That could really affect that current family. Beneficiaries, mortgage life insurance. Again, sometimes when we take out a mortgage loan, we have mortgage life insurance. Well, how is that going to play? Well, it may depend on who is getting the home and how is that going to be looked at. And that is really a conversation to have with your lender because they have a stake in this mortgage life insurance because it's there to pay off the home loan in the case of one of you dying. Well, now who has the home may also have the mortgage life insurance requirement. And so how does that value from a cash outflow position, because now you're having to pay for something that, again, you both were paying together. And not having any insurance at all is not a great place to be, right? You should look at it from that perspective, especially if we're talking about spousal maintenance. Remember that whole alimony piece. Well, if you're looking to rely on the alimony and or the spousal maintenance, and the person, your ex-spouse, dies, then there goes the spousal maintenance. So one of the ways that can be handled is by having an insurance policy where you as the ex-spouse are the owner. The other piece is a lot of times that you will be asked to cash in your life insurance policy, potentially to pay off the debt. That is not a good recommendation because now you're older. You may have had that life insurance policy, from the beginning of your marriage. when you were healthy and younger, and now you're a little bit older, or maybe have some health concerns. And so if you cash in that life insurance policy, there's nothing saying that you're going to be able to get another life insurance policy or get a life insurance policy at the same premium price that you got much earlier. Again, that could put a financial strain on you. Right. So let's talk about gray divorce. So gray divorce, if you look at it from a Wikipedia standpoint, is a term referring to the increasing divorce rate for older, quote unquote, gray-haired couples in long-lasting marriages. And a famed couple is Tipper and Al Gore. So after 40 years of being married, Tipper and Al Gore decide that they want to separate, right? And this is just one example of how gray divorce has manifested itself, I think, in today's world. So projections show that there could be by 2030. So we're really only talking about 8 years from now, like over 828,000 gray divorces. Think of the population that we're in today. So yes, we've just, we're just coming out of a pandemic, which has decimated families and decimated financial stability for many, many people. And right behind that now is gray divorce. And when we look at gray divorce, again, here are some of the reasons why gray divorce occurs, right? Money issues. Well, money issues, like I said in the very beginning, is one of the major reasons that divorces happen in the first place, 45%, right? Or better. Infidelity, addictions, autonomy of women, which is really interesting. So as women have become more involved in the workplace and coming into the workplace, and I want to preface this as saying pre-pandemic, women have had a stronger voice when it comes to what it is they want and when they want it. And sometimes that doesn't necessarily mesh with how their marriage started out. And so that can create a challenge. Now, I know that many of you are thinking, well, because of the pandemic, many women have, left the workforce to take care of their children because of the pandemic concerns and health concerns and all of those pieces and parts. And that is absolutely true, which puts even a bigger strain on families to some degree, and even more so from a gray divorce standpoint. Empty nest syndrome. We stayed together for the children. Now the children are grown, they're out of the house, and now we're done, right? We don't want to be together anymore. We've just been, biding our time until the kids are gone, and now we want to go our separate ways. Retirement. Retirement is very interesting because you're together, during the working years, you're working really hard towards that point in your life where you can sit back and relax in retirement, and you find now that really you have nothing in common anymore. Looking at each other every day is not what you anticipated it to be. It's putting a stress on your marriage, and so people want to divorce. And the other thing that's interesting is the longer lifespan. We are living longer. So when you look at all of these issues ahead that I've shown here, money issues, infidelity, addiction, autonomy of women, empty nest syndrome, retirement, the other thing is that we're living longer. And because we're living longer, all of these things come into play. So again, there's a lot of different reasons why gray divorce is happening, but the big thing is that it is occurring. This is what I think is really significant, and why I talk about gray divorce is because the older we get, the lower the chance of financial recovery we have. So if you're divorcing in your 20s, your 30s, and your 40s, right, you still have a pretty long runway. You're probably still able to go out into the workforce. You're still able to do all the things that you want to do. You've got, 20, 30 years in front of you before you're even thinking about retirement in some cases. And so you can work a little harder, put away a little bit more money with some financial guidance in order for you to have recovery. But if you're going through a gray divorce and you're in your 60s, 50s, 60s, 70s, right? You have probably been out of the workforce, or it's going to be sometimes difficult to get back into the workforce. And so the chance of financial recovery from you going back into the workforce may be difficult. So we really need to understand some of the issues now that have to be put into perspective from a gray divorce lens. Now, remember, earlier on I kind of listed out all the assets that we need to look at and all of those things. But one of the things that I didn't touch upon is Social Security, right? Because now you could be in full retirement age, looking for Social Security. And how does that work? Or you could be, 62 and looking at Social Security, taking Social Security early. How does that work? Well, as long as you've been married to your previous spouse for 10 years, then you are eligible to actually take a spousal benefit without implicating your ex-spouse's benefit at all. So you're not touching your ex-spouse's Social Security benefit, but you are eligible for 50% of that benefit from a divorce perspective. And the importance of doing that is the fact that their 50% of their Social Security benefit could be higher than your Social Security benefit, especially if you've been, taking care of the family, out of the workforce for many years while you were doing that. Yeah, you don't have necessarily the largest Social Security benefit that your working spouse has. And so taking 50% of their spousal benefit, of your spousal benefit of theirs, could be helpful in part of your cash inflow, the ability to get cash in. You just have to make sure that you were married for at least 10 years. So 10 years. And then you must be divorced for 2 years so that you can take the spousal benefit without your ex-spouse having to take that benefit. So your ex-spouse, if you've been married 10 years and divorced for 2, your ex-spouse does not have to take their Social Security benefit in order for you to take your spousal benefit of their Social Security benefit. Okay. The next thing is, what is the survivor benefit option available to your ex-spouse upon retirement? Is there a survivor benefit option? So this comes into play for federal employees, military, any individual that has a defined benefit plan, not contribution plan, but defined benefit plan. In other words, they get a pension. There is usually a survivor benefit option available to them. Now, in the defined contribution world, 401k, there is that beneficiary component piece that is part of the defined contribution plan, which is different than the survivor benefit plan. So the survivor benefit plan usually says something along the lines that when your working spouse, now your ex-spouse, passes away, part of their pension could come to you. So this is something to consider in the division of assets, is do you get a piece of that survivor benefit or piece of that pension that your ex-spouse will be entitled to upon retirement? What about healthcare coverage? This is also something, again, you've been married to your spouse. We're talking about gray divorce now. You've been married to your spouse for a long time. They have health coverage. You were not in the workforce, or you left the workforce much earlier than they did. And so your health coverage was covered by your spouse, now your ex-spouse. And how does that work? Are you eligible for coverage still, even as the ex-spouse? Do you have to look at COBRA? Are you going to have to go on to the health insurance marketplace in order to get coverage for yourself? And if you do, what's the cost of that? Again, we're trying to figure out, what you're going to need to get from this divorce in order for you to maintain or at least have as good a financial recovery as you possibly can. And what about asset location? And when I talk about asset location, I'm talking about your investments at this point. And you really, at this point, should be talking with a financial advisor to find out how do you set up your investments. If you're going to get a portion of that 401k, or you're going to get a portion of the traditional IRA from your ex-spouse, how do you set up that asset so that it is going to work the best for you? What is the best way for you to be able to manage the asset that you now have in front of you, because that may be a majority of where your cash flow is going to come from. Sometimes the best option here is through mediation or through a collaborative process, because when it gets to be contentious, it can be very difficult from not only the financial aspect, but just from an emotional and health aspect, because again, you've been married to this individual for quite some time. So I tend to say, if we can go through mediation and if we can go through a collaborative process for a grain divorce proceeding, that sometimes that's the best option. Not always, and sometimes it just doesn't happen because both of the individuals don't want to go through that process. They just want to get attorneys and they want to go through this process. But just remember, in the retirement planning phase, because this is later off in life, that you want to keep some of these things in perspective. Okay. Next steps. So the client's single now. They'll need help with financial planning as a single person. They'll need to look at their life, their health, their property, right? And they definitely need to look at estate planning. So you need to think about it from this perspective: your life insurance, your health insurance, your property insurance. What is all of those? Because that means that that's going to impact your budget from a gray divorce. Estate planning, you want to update your beneficiaries if you've not already done that. You want to make sure that the documents have been retitled correctly. So if we're talking about you get the Subaru and he gets the Toyota, right? But it's jointly titled. You want to make sure that now whoever really gets the Subaru has it in their name, and whoever gets the Toyota has it in their name. If you're getting the property, if you're getting your home, right, there probably was a buyout that was necessary. So refinancing as soon as possible is important so that you can do that. Now it's a little bit difficult, obviously, as interest rates are rising. And so again, this has to be taken into consideration. How are you going to split the home? Or how is one of you going to take the home that may have been your home for a long, long time? And if it still has a mortgage on there, then again, having a conversation with the mortgage lender becomes important. Maybe you can have, a mortgage release. In other words, the mortgage lender will just release the ex-spouse from the title and the mortgage, and you can just acquire the mortgage at the rate and payment that you currently have, other than refinancing it, especially in times like now where the cost is really important. From an interest rate perspective, because it continues to increase at this point. So, we don't have the low interest rate environment that we had in the past. So these next steps become really important. It's not just a matter of getting through the divorce, getting the assets moved over. It's also, what do you do with those assets and all of the pieces and parts behind reestablishing yourself as a single person after years and years of being married and being later in life. Sometimes we forget about it because we've done it so far in the past. I, for instance, have been married to my husband for 41 years this year. And so, sometimes recently I was going through some documents that, we had savings bonds that were sitting in our fire safe that I totally forgot about. So it happens where, you've done things in the past, you've put them in a safe place for safekeeping, and they're not top of mind. It really is important that you kind of go through all of this process and look for people to help you. Don't try and do this on your own, because I think that is a very stressful process. It's stressful to go through a divorce, but it's even more stressful, I think, to try and put your life back together all by yourself. So seek the advice, whether it is a financial advisor, whether it is a certified divorce financial analyst, whether it is, someone in the mental health industry, but call upon all of those support people to help you through this process so that you can navigate it. Look for a good outcome to come out of this from a financial perspective, and be able to reset your life back in a path that is more comfortable and healthy for you. So Dana, I know I went through that kind of quickly, but I hope that what everyone got out of there are some pieces and parts that they may not have thought about, uh, when you're talking about the dissolution of a marriage after many, many years or later in life. So I hope that was helpful for anyone. And I'm happy to, if anybody has any questions, I'm happy to take them now, or I'm happy to take them, later. They can email me uh, later on, and I'm happy to talk to them about their specific situation.
No worries. I thought that was extremely helpful in going through a lot of the things that I feel like people just forget, or, when you're in the midst of going through something like that, that can also be a traumatic experience. There's a lot that you forget about, especially if you've been married to someone for probably over 20, 30 years. Unraveling all of that. I mean, I can only imagine how tough that can be in the middle of all the other things that you're probably just dealing with that stem from that. Um,
Absolutely.
I think there's a lot to be said within all of that, and unpackaging, and just kind of taking some time, maybe annually or quarterly, to go through all of your things. How often do you suggest people kind of do checkups on their titling, or just kind of making sure that they compile things in a place that they know where it is, right? You talked about kind of hiding things from ourselves and discovering them much later when it may not be so advantageous.
Yeah. So, I think that everyone should have a financial review. So if you have a financial advisor, most definitely you should be speaking to them, every year. Same thing with whoever your property and casualty person is, making sure that you have adequate coverage on your vehicles and on your home. I can't even imagine some of the people these days who are in fire areas where the fires are raging, right? So, again, it's one of those things to, if you can do that every year, every other year at the latest, to go over and make sure that you are covered adequately from a property and casualty perspective as well. As I think that's really important. If you haven't talked to an estate planner about getting your will in order, that is something that you should do. And that is something that you probably should look at every couple of years, 2 to 3 years. Anytime you have what I call a qualifying life event, right? The birth of a grandchild, for instance, as we get older, a relocation, a purchase of a new home, anything like that, you should relook at, again, your finances, your property and casualty, coverage, as well as what your estate plan looks like, because all of that falls into place as well. And again, you may have things in a will or a trust that no longer is applicable. And so the worst time that you want to, that you want to happen is when you're sick or incapacitated and now trying to get that right, and God forbid you pass away and don't have that aligned the way that you wanted it. So taking a look at that, and you can get a will done. I'm not a real strong proponent of doing it online. I know that there are things that, wills and trusts that you can do online. I just believe that when you sit across from a person and you talk to them, they'll help you navigate it a lot better, because they can ask questions that sometimes are not asked in the algorithm of an online. But worst case scenario, I would rather you have something than nothing. So if that is the easiest way for you to do it and the quickest way for you to do it, do something when it comes to it.
No, absolutely. Absolutely. Definitely, a big proponent of talking to someone, but at the very least, just have some sort of document in place so someone has, at least a framework or a guideline to work off of in case of emergency. But thank you so much, Angie, for coming on. I'm really excited to have you back for our fireside chat. So everyone look forward to that as well. And thank you for tuning in for this episode of the Represented series. And again, you can always catch up on our various social media channels at Chip Professionals, and then also on our website under Chip Live and the Represented series. So Angie, thank you again for your time. You're very much appreciated, and thank you for all of your contributions to this financial industry.
Well, thank you, Dana.
Absolutely, absolutely. And we'll see everyone soon. Take care.
Bye, everybody.